Okay, good morning and welcome to the Minervini Private Access Training Room. My name is Bob Weissman. If we could do a quick sound check by raising your hand, that'll let me know that you're hearing me loud and clear. Hope everybody had a nice long holiday weekend, at least here with the market being closed yesterday. Okay, great. And let's also welcome Mark Ritchie into the room. Mark,
Morning, everybody.
you can raise your hand letting me know you're hearing Mark as well. We're going to get started right away here, try to get through a lot of questions as I know we've been backing up a little bit week by week, but we'll have some peppier kind of quick answers for a bunch of them. Starting though, Mark, I wanted to review, of course, the trades that Mark has taken this morning with IBP, which is up here on the screen. And if you want to just take a quick moment to share.
Yeah, sure. Just coming out of this right-hand side here, we had a number of names kind of pop right on the open. This one was one of them. It's pulling in, squatting a little bit here, but it's early day, so this is, if it's going to squat, this is a better time. Let's see how it closes. And this is in that group, the building group, which is, it's sort of rotated in and out. We've played some of these before, and this one was sort of setting up here again. Decent fundamentals too.
Yeah, the pivot was a little bit lower. I think we got our entry here around 117 area, but the pivot really was there. So it's coming right back to the breakout area. And as Mark always talks about, early morning reversals is the time that is beneficial of a time for that to happen. And let's see if we can't get a afternoon rally on that early morning reversal. We also did get on board with HDNP. Let me pull that up real quick. Clear that out.
This is a name, this is sort of the David Ryan, just draw the line, setup. You can see if the stock can really clear this 81.20 kind of area, there's just not a lot of trading that happened, sort of to the left before that.
Even all this.
Right. And if you look, this stock had a really big run, 20 to 80. And if you look even at the fundamentals, big breakout year in 2020. And that's kind of what you saw. The stock, probably rallying in the anticipation of really good earnings. But this is sort of that first base off of that. So if this can come out here and clear, I think there's a good possibility it gets in a new high ground, because there's just not much overhead if we can clear this sort of 82 area. Again, triple digit earnings too.
Yeah, clearly you can see a little scattered with some of the
big
earnings,
sales
but
improvement too.
The sales is very consistent across the board now, growing, as you can definitely see. So that is where we got that entry on that one. And Mark also was taking some profits on some of the names that he has been lighting up in last week as well, picking up GM. Let me clear this out.
Yeah, GM has definitely been pretty incredible, especially for, sort of a larger cap stock. Had a really nice move. It just goes to show you these techniques work regardless of, the name. Sometimes Mark will put on a name that, trades, 50,000 shares a day, and you got, a name like GM that trades 15 million a day. So there's just a little bit for everybody, depending on, time frame, what you like. And some of this I think has been news driven, but it's definitely extended. Those of you though, again, in the study session, the study video, Mark talked about, listen, if you want to move your stop now, I mean, you can highlight, Bob, right where the 50 is going to come up. You can play this for a much bigger move, but the distance between those now is going to be a painful give back. So this is where maybe you sell one or two parts and finance that, that ability to hold, or as Mark did, you kick it out and turn that edge over and move on to something else.
Yeah, and obviously Mark is closing the position now with that 20% gain, but he had been lighting up into this strength.
Well, 20% on a name like GM in 6 days, guys, that's a pretty, that's an alpha move. If you don't realize some of that, I don't think, that's just not prudent. That's not the right way to handle it.
Yeah, and of course, there's been some talk with their news getting involved with the electric vehicle market, and have a merger with Fiat Chrysler, and So you have some moving going on in that industry for sure. Tesla, of course, leading the way. Let's get to the questions. Where one question we had was Jeff was asking if we ever, or if Mark uses the Market Smith advanced decline line on individual names. Uh, you could probably, or accumulation distribution rating. Do you use either of these factors for your analysis on the stock, Mark?
No, I don't.
Okay. And as far as advanced decline on the indices, which Mark does use, of course, you guys know from the risk model he reviews that. It's just your um, advancing issues versus decline issues. That information is off the exchanges. It's pretty public information, so that's nothing unique or proprietary to MarketSmith. But Mark does um, has that as part of the risk model, which is what he reviews each week on the study sessions. Another question was being asked about STTK. Let's just bring that up. Having a real low volume kind of pivot that is developing here. The question really being is, it is a little spreadier of a stock as well, a little thinner traded. Is that a good thing or a bad thing insofar as if the stock were to drop and sell off, it could sell off pretty hard or pretty fast? Comments about that, Mark?
Well, sure. Spready is just, that the knife cuts both ways, right, guys? So spready can mean, yes, it can drop quickly as well, which is why you want to see it form a proper pivot point. This stock just doesn't really have much of a pivot here. And see how it ran from 40 to 60, almost kind of parabolic, and then pulled in, say 30%. I would want to see this, put in some time and really put in much more of a tighter pivot at this point. But no, you shouldn't be necessarily scared of something spready, but you need to realize, of course, you may have to position size accordingly because there may be a little more slippage getting in and out of the name.
Yeah. And ultimately, guys, what you'll learn from Mark Minervini's methodology is we have an edge in our setup, our ability to identify that pricing inefficiency, if you will, that supply demand dynamic is in our favor. And in a uptrending stock, that's what we're looking for. That dynamic and that edge will play out over time to be at a positive for you, not a negative, even though at times when things do so often you take losses, that can work against you, like Mark said, but there's a lot of other times where it works for you. In the market, in the current market environment of high sentiment readings that Mark has been talking about, does it make the most sense to focus on names that are extended with short bases that have high RS ratings versus names that are making an early turn but have lower RS ratings? Thoughts on that? And he's given an example. Let's pull up CARG here. Whoops, CA.
Well, listen, the answer the first part of the question. You don't ever want to just focus on something with a short base. Ideally, you don't ever want, just because it has high RS but a short base, uh, something that's not properly formed, regardless of the environment, is not a good idea. It's sort of like saying, well, just because it's been a little trickier, should we go with worse setups or lower quality? No, lower RS generally means lower quality. So whether it's high RS but a really short little pivot, I wouldn't call that higher quality either. Now you may know whether you're right or wrong quicker in a higher RS situation with a really say short little pivot. But the trickier it is, the more selective you want to be, and you don't want to take your criteria and go the other way, meaning to say, well, it's a wild market, so I'll just start shooting at stuff that is wide and loose. And this is exactly how I've been handling it, by the way, guys. I've been more selective of late, not the other way.
He's also sharing LOB being the example of a high extended stock that he's referencing, or any other name that could be considered.
There's as I've said many times, I tend to, one, I try not to have favorites at all, but I certainly, if it's going to be a 96 RS or a 70 of the two examples you just gave, I'm looking at the 96, all things being equal, no question about that. And actually, Mark made this point again in the little weekend video, that there's a lot of people focusing on some of these former mega cap leaders, and their RSs are just continuing to go down. while we've had some smaller cap and other names that have kind of rotated to the forefront. Now, how that shakes out longer term, whether we see things rotate back the other way, that remains to be seen. But this is sort of the beauty of this overall strategy is you don't have to get stuck in any one spot or one place. You just wait for the stocks to come to you, wait till they set up proper pivots. And then in that you sometimes see themes. If we see a lot of early turns, well, we'll play a couple. But even in general, I would say that you don't want to get you don't want to get, stuck just looking for one idea or one area. Let the trades come to you, continue to do this screening, and then, practice progressive exposure.
Yeah, Mark did go through in detail the FANG MAG name. So if you haven't watched the weekly study session, go make sure to do that. And by the way, that is typically available, even though we post it first thing, first day of the week, typically Monday, this week, Tuesday morning, pre-market. It is actually available often Sunday evening. We just don't post that to you, but you can always check to see if it is up there. Question, James is asking, what was your average gain loss ratio in the beginning when you were just turning over the edges and kicking the entire positions out? Was it any different than your ratios are now?
Yeah, I was a little more higher win rate, lower average gain. So it was a little more 50-50, a little below 2 to 1. Where now my win rate's a little lower and my average gain is more like 3 to 1 in a good environment, 3+ to 1.
Quick question from Fargo is asking if Tesla would be considered tightening up here on the right-hand side. Is this developing a pivot or is this
Okay.
extended?
Yeah, this is way too extended right now. And this is a stock that has now gone from, it's not a secret. I would No, I would definitely not be playing it. Now, if this were to really stay tight for say another week and put in another power play, you could play it. But you remember Mark talking about the whole idea of power plays coming from a period of dormancy. The stock is the worst kept secret in all the stock market. Again, doesn't mean it won't go higher. I've traded Tesla a couple times over the last year, did really well on it for one of those runs. So if it sets up and you can find a tight entry right now, that we're talking 6 days, I would just say keep it on the radar right now and wait for a better entry.
Yeah, and to
And
get
treating it as a tradable situation only at this point, to be really clear on that.
just to highlight that point of where Mark has talked about from dormancy to something really special is if it kind of from here, whoops, might have done that, but this is not dormancy by any definition, going from 50 to 800 in the last 2 years. So this is not the circumstance of what makes for what Mark's power play is all about. Let's clear this out and get back to the daily. Question from Dylan. Mark, question on how you handle progressive exposure. You have said that in the beginning of the market move coming from cash, you tend to say I'll risk X% of my portfolio and then use open trade equity to finance additional risk. Just trying to read a long typed out question here, guys. Sorry. At what point in that process do you decide to move the initial risk up to lock in a total profit, and then should everything have a huge gap down and all stops are hit, do you wait until you're fully invested to do that, or evaluate along the way, taking into account what stage of the market we are in? If you're
Okay,
getting the gist of that.
Yeah, there's a lot there. So last question first. I'm always evaluating along the way. And you always want to be evaluating along the way, guys. Taking a pulse on things. How are things acting? Good example, last week, I was more invested than I am right now because, the things I owned started to slip. So it doesn't matter that there are maybe other names on Mark's open positions or other things on Buy Alert or whatever that are working well. What I own starting to slip, and I'm getting hit on a few things, I have to act accordingly. So you always want to be evaluating along the way and looking at the stocks that you own. Now, in regards to the question of, so let's say I am deciding you coming from a position of cash and you're going to buy one or two names, or maybe you buy a couple names, but you're going to risk, say, he asked, say, a certain percentage of your portfolio, a couple percent maybe. At what point are you deciding to not give that back? Well, if things are going well, I don't think about it in regards to, well, I want to make sure I lock in my initial 2% outlay because, if I'm doing progressive exposure properly, I've more than hopefully made a multiple of that at that point. And that's where, if you're not understanding that the idea of progressive exposure is so that you can increase your ability to gain without increasing your risk. So you're making sure you're only leaning on those profits, which means there are times where you might take, so let's say I'm going to risk 1% of my portfolio. And then based upon the names I'm buying, I'm up 2, 3, 4%. Well, now I'm generally willing to take those gains and either buy more names or take more risk. So if I'm up 3%, I might take another two and stair step my way up. Um, Again, this is assuming, of course, there are more setups, more low risk entries, and you're getting that positive feedback. So that once you've put yourself into a good situation, if I was initially risking 1%, guys, I'm hoping to make 5 to 10 times that in a good period, because my initial risk is small, and then as I start pyramiding the exposure up, I'm taking more risk as things are working. I know lots of people have lots of questions on this, and yes, there will be times where you pyramid into a situation only to have to pyramid right back down. But the way I think about it is that initial outlay should be small. That way you can build upon it. And I can take, so let's say there will be times, guys, where maybe we get a follow through day. You come out of cash and you buy two names, you get stopped out. And then the market rolls over and you do that two or three more times, a couple of times. So you want to start small enough where you can take several initial shots at sort of timing things correctly without taking any serious damage. That's why Mark says, well, when I have drawdowns, they're small, because he's shutting it down quickly initially when things aren't working. He's taking that progressive exposure, especially initially coming from cash, and watching it very closely. So that may not answer that full question in terms of when do I lock in my initial risk, but I'm saying I've already paid for it if I've done it properly.
Mark also did go through this over the weekend study session as well. So Dylan, having the ability to watch that, or in the video archives, there is a tutorial that Mark did do regarding progressive exposure, which actually was referencing the same chart that he showed in this weekend's video. That should help fill in some of the questions that we get commonly about this question all the time with progressive exposure. Ideally, you just want to scale up in your size, in your risk, in your exposure to the market, calculating what your risk is. You know what your risk is with every trade that you have open, based on the profits that you have earned beforehand. This is how Mark Minervini keeps his drawdowns incredibly low and keeps his profits locked in. Kirill is asking both questions to both Marks. What is your average holding period for winning stocks, and how does it compare to the last 5 months? If you could provide some actual numbers in days or months, that would be greatly appreciated.
I haven't run the last 5 months as a comparison overall in terms of like where to bring my long-term numbers, but in general, my losses are about 2 days on average, and the gains are about 9 to 10 days on average.
Okay, so that's really, and that's dramatic, and that's changed from what were the numbers
No,
before?
I'm saying those are kind of where the long-term numbers. So
Oh, okay.
the last 5 months, I'm saying I didn't look at that as a subset within the larger, is what I was saying, to
Mhm.
break it out. But just off the top of my head, though, I was definitely, for a period of say last year, I'm trading things even quicker. So kicking things out, I would say, if anything, my average win probably came down in terms of holding time, because we were just seeing some things really popping. So I was just kind of turning and burning certain names. You just kick them out and move on.
Yeah, not sure about the last 5 months, Kirill, but last year, 2020, was an extremely fast market. We have, of course, now 12 years of data, having the service for that long, and our average holding time is typically about 5 weeks or so. In 2020, that number dropped to about 3 weeks. So it was dramatic how fast some of the moves were happening and how quickly we were making some profits. The average loss, historically speaking, is about 2.5, 3 weeks. So that 2-to-1 metric of average length of time holding a winner and average length of time holding a loser is right there. Last year for 2020, our average holding period for a loser was just over a week. So again, those numbers were cut by about a third to maybe half in both cases. So dramatically fast market, which is something that you would expect after the V-shaped bounce we did have off the March lows with the uh, April and May moves that we did experience a lot of that trading in. Guys asking, how do you decide if a stock is extended? For example, power play looks, of course, extended being so far from its base and its 50-day.
Yeah, when we use the language extended, we're talking about extended from a proper buy point or from a low risk entry point. I mean, we could take a look at, like, say, ARVN was sort of a power play. Um, while it may be really strong, if you look at where this name was bought last week, coming right through this sort of failure reset low cheat here, that is an extended in terms of where the purchase price is. Now, if you want to purchase it, it looks extended. And the other way I think about, if a name will act normal, meaning if the normal price action will knock you out of a name, you are potentially buying extended. So just ask yourself, if the stock acts, and this by the way is sort of a really good question, in terms of your overall, where are you at psychologically when you're putting on a trade. It will help you prevent, you know, um, potential FOMO type trades. If you just ask yourself, if the stock acts normal and it will knock me out, say with a tighter stop in that 5 to 8% range of normal behavior, the stock will pull in 5 to 8%, then I'm buying extended. And here's a good example. If this stock pulls back to where it was purchased, it will definitely pull in 5 to 8%, which would be normal, knock you out, then turn around, go up and work out. And this is where you don't want normal behavior at knocking you out. You want abnormal behavior knocking you out. And so, yes, power plays sometimes look extended, but again, if you're looking for low risk entry points, the purchase points are not. Where, just look at where Mark bought this and put his stop. This is also a good example of why you don't just, if a name shakes out, you don't just take it off your list. And we've seen that, over the last, say, 2 3 months. There's been some names that have a little bit of pivot leakage, and then they kind of reset a little bit and try and go higher. So
Uh, I think that was a good explanation. Susan's asking if you can explain the difference between a secular bull market and a cyclical bull market.
well, this is probably a better question for Mark, but I would just say the secular bull market is one where we're in a confirmed sort of longer term major advance, where a cyclical bull market would be, say a shorter duration or maybe a larger advance, but where you're still, say, I guess some people would have said maybe 2003. A lot of people argued was a cyclical. I wasn't trading then, by the way, cyclical bull market, because we were in a larger bear market decline still, but then we had a nice long rally, sort of within it. Some of this is semantics, guys. It's really not that important in terms of what we're doing here. And some people even have different definitions for these things. I would argue we're definitely in a secular bull advance, because we're at new all-time highs on all major averages. But it doesn't really matter we're just looking at stocks here. So
Yeah, it's the bigger move. So, as an example, even last year was a huge correction, but still would be considered a cyclical bear market within a very defined secular
secular
bull
bull,
market.
right?
And that's really the bigger time frame is the secular move. You're going to have corrections here. We had a 20% correction here, and we had 15% corrections here in this 2015-16 period. So it's just, these are cyclical in nature, meaning shorter term in nature, and they go through their motions before resuming the longer term trend. That's the secular move. Kirill is asking, Mark said that with a smaller account in the US Investing Championship, you would expect over 1,000% return for the year. What would be the strategy difference to achieve this? And what are your thoughts on that one, Mark?
Well, listen, the strategy is not going to be any different. The tactics might be a little different. So the idea that just because, Mark, says, I think I do 1,000% return, which I think is absolutely the case on a smaller account for some of these, sort of competition type accounts. He's not going to do any different strategy, but he's just going to be trading a lot more. He's going to be more aggressive. He'll use higher level of margin. He might put, the entire account in one or two names, trade it very quickly. Listen, guys, at some point, size is an impediment to performance. Now, it doesn't mean you still can't put up a really good return, but and Mark was making this point in a prior video from, I think, a few weeks ago. Some of these guys in the old days of the U.S. Investing Championship, these were $5,000 accounts, or something like that. Well, yeah, you can definitely put up, much larger percentage return on smaller money, because you don't have any liquidity constrictions.
Yeah, as a matter of fact, um, we didn't mention, but the final results of the U.S. Investing Championship did come out this past week, and the winner actually did have a 941% return. That's more than 10 times his money. That's unbelievable. And I don't know the size of his account, but I do know the size of the account of a number of our members, where we had 13 of the top 26 performers were all members or students of Mark Minervini. And having said that, I know with several of them having even more, 8 of those 13, by the way, having over 100% returns. I do know with some of those, they were some very healthy 6-figure accounts that are now very, solid 7-figure accounts. So we're not, these people didn't necessarily do it with just a little tiny account, even though you, as Mark alluded to, can be more aggressive having 20 or $30,000 in the account. If that's a relatively small amount of money for you, you can go all out and really be as aggressive as one could be with it. But I do know with a number of the performers we had, some very impressive performances with very realistic, even our own Mark Ritchie, who wasn't part of the contest. But what was your final year numbers, Mark?
They were good, just over 300%.
300%, and he had a 7-figure account, now a multi 7-figure account doing that. So that's kudos to everyone who did well with that. And again, a number of the names are names that we see in here on a regular basis. Corrado is asking, many stocks within the residential construction sector are tightening up. Mark added a couple of the names to Bylard IBP, which was one today. And he mentioned a couple of the names here, Toll Brothers and Beazer Homes, Lennar. I wonder what propelled him to choose IBP and discard the others, as the price action is quite similar in the fundamentals with them as well.
Well, the short answer is it's probably those other names aren't going to buy alert. So either the RS isn't as high, or the setup wasn't as constructive.
Yeah, just take a quick look at in the Toll.
I mean, you are right though, because I did notice Lennar, and we've seen a few of these other ones.
Hopefully, Corral, you can. I'm sorry, Corrado, you can see though the constructive development of their price action is nothing close to what you're seeing.
Right. You've got IBP that's trying to come out of a pivot today, while these other ones are still kind of working on right hand sides.
Oh boy, this happens all the time. Sorry, guys. Yeah, IBP coming off. Nice
right.
here.
You look at that. Look at that right side compared to the others. It's more formed, and it's trying to break close into new high ground, certainly, or going near to challenge the old highs.
Yeah, and
relative to the other ones.
That's just much more constructive looking than any of those other charts I just pulled up quickly. Dylan's asking, Mark, have you ever looked at your average time it took to get fully invested from a cash position, either days, weeks, months? Can you share what was the fastest time? An example, when did you become fully invested off those lows last April?
A good, interesting question. There have been times where it's been quick. A couple days would be the fastest. Back in April was slower. So I was probably 50% invested for, 5, 6, 7 days. And then there weren't a ton of setups right off of, say the bottom. So I just sort of bought a name or two. And this is something I do. Sometimes you get maybe some accumulation comes into the market. And Mark talks about this, sometimes the setups are coincident. And then or they're before or sort of after the lows are formed. And he showed that again, if you look at that, the study session video where there were a lot more stocks as the market, he gave that example back in September. The market came off and, tried to bottom. He bought Snap. Then, it was still trying to find a bottom. He bought one or two more names because things were kind of holding. But then as the market came up the right-hand side, he was buying a lot more names. And that would be the most typical for me. So let's say you may get exposure at or near the lows or within a few days of the lows, but as things are kind of either coming up the right hand side or the market then sometimes pauses, you see a lot more pivots develop. But on average, you know probably a week would be, it wouldn't be months, that's for sure. If we're in a good environment, it would not take me months to get fully invested, and ideally, at the fastest might be a day or two. But if things are really working, guys, and you have setups, I would say you want to start stepping on the gas. Assuming that you have some experience and know what you're looking for.
All right, I think we're gonna get Mark to join us here.
Yeah, can you hear me?
We can. If you could do a sound check, guys, with Mark, just raise your hand. Mark,
Just real, if you're hearing me, just raise your hand, please.
sounds good.
Okay, good. Sounds good. Just wanted to pop in here and join you guys for a little bit. So a few things. One, I just want to go back to a few questions that I heard because I'll tell you, these are definitely extended bull market questions. We start getting these questions about Tesla, whether it's a power play, and I got to tell you, this is a very dangerous. These are very scary questions that I'm hearing. And let's bring up Tesla. You know, Again, this is a stock that is hyper extended. Now, I don't know, maybe it doubles from here. Who knows? But this is not a power play. Okay. You guys have to understand this is what's happening here. And I'm seeing and I'm not singling you guys out, but I'm seeing a lot of people on Twitter, and everybody's got a service now and is an expert after they're trading for 2 years and they're in a bull market. And next thing you know, they're trading every 3 or 4 or 5 day sideways move in a high relative strength stock is called the Minervini power play. No, it's not. No, it's not. And many of them might work out for a little bit. Maybe you'll get a month or two where they'll work and you'll get sucked in like a Venus flytrap where you'll think that's the way to do it. And trust me, it's going to lead to big losses. It's going to lead to a lot of losses and a lot of these people blowing themselves up because these are hyper extended stocks. This stock is hyper extended. It's gone from 400 to 800 after it already, I don't know, what did it go up? Fivefold, tenfold? Power plays come from a period of dormancy. And here's the other thing that I'm hearing a lot when we hear these questions. What I'm realizing is that a lot of you guys either are not reading my book or are not understanding my books, because most of this is fully explained. The criteria, especially if you've gone to the Master Trader program, I mean, it's explained over and over and over. But the answers are all in my books. All right. There's a definition. There's a section on power plays that shows the exact definition from a period of dormancy. All right. You look at Tesla, is that from a period of dormancy? Bring up a weekly.
Sure.
Again, you can't get too tricky and want to trade so bad that you start trying to fit everything into what you want. Go back to the fundamentals and have a set of rules, and then go see, does the stock meet that criteria? You got to simplify it. Okay, you got to take this whole process and make it as simple as possible. It's a very straightforward process. You screen stocks. If you have Market Smith, you screen stocks. You look for the setups. You buy the ones that break out. If they're working, great. You buy more. If you're seeing a lot of stocks breaking out, the market's healthy. If everything's failing, it's a bad market. I mean, it's a very straightforward process. Now, what defines whether you take some of those trades? Well, you've got to learn what a good setup looks like. And that's where you go back to, if you went to the Master Trader program, you have a manual with 400 pages of examples, and you start looking at those setups and seeing, does this look like that? Tesla, no, that doesn't look like one single power play anywhere in any of my books or any of the Master Trader program material, or in anything that you would read from O'Neill or anybody else that's an expert on high tight flags and power plays. This is a very, very extended stock. Now, when it made that first move, if you go all the way back, December 19, you'll see it goes from 40, actually it goes from, about 40 up to almost $80. That's not quite a double, but there's where, that right there, that's where that's what you're looking for. You're looking for that scenario and buying there. You see the difference? Big difference, right? That's after it's moved sideways for a period of time, and all of a sudden something changes, and you see this big move up. You see that's the biggest up move. That's the biggest weekly bar up in the entire, going back and looking at the entire history of that stock as far as what's in that chart. Probably if you go back even further, and then from there, of course, it makes a big move. But anyway, I just want to, I'm seeing over and over on, and this happens every cycle, as the market goes higher and higher and higher, and stocks get more and more extended, more and more amateurs on Twitter and wherever, before that it was newsletters, start recommending these names that really are not meeting the criteria. But what happens is because the market's so strong, it works for a little while. So everybody feels like a genius, but believe me, they all give it back and they all blow up. It's because the techniques are flawed to begin with. Again, I don't know, maybe Tesla goes up, and doubles from here. And again, if you're going to try to play some type of, little, pullback basing movement, okay, there's nothing wrong with that. If you're a trader, have a stop, but realize that this is a very extended stock. Another thing that I heard was, also let me just point this out too. As far as there was questions about what defines extended. So again, extended from a base is one thing. So for instance, if you look at Tesla here and you go back to November, you can see there's a basing period, right? That starts in August, September, moves sideways, and then you break out from there. Okay, now when you get away from that base and you're up, you're up at $500, $600, that's extended from the base. But looking on a longer term basis, you want to count bases also. You want to count how many bases has the stock formed since it started making its big move. And usually you measure that from the most recent bear market, or from when it started into a stage 2 uptrend. So you can do that two ways. So it started in a stage 2 uptrend. You can see back there after it put that little power play that I was talking about. And then of course, you got that big correction, right? So if you start counting from there, coming out of there, you have 1, you have 2, another base, you have 3. So now you've rallied after, you're in the third stage, maybe fourth stage base. So you're not early here, as Mark Ritchie just pointed out. This is certainly not a secret, this stock. But can it go higher? Absolutely, sure, it can go higher. It could double, triple from here for all we know. But again, this is all about risk management, and just be very careful with the extended names. Okay, another thing, progressive exposure. So I went over that a little bit in the video, right, to this week, and showed how, I would get into a few names. Now, again, you were asking about, the percentage maybe of exposure. Again, this is going to be a lot of this is artistic. When I say artistic, I mean it's unique to your own circumstance. I mean, and again, if I was trading like the $25,000 portfolio that someone asked about, and how would I get that big return? Yes, as Mark Ritchie said, I'd be putting the whole account in maybe of just a couple names, and going full margin. Would I do that with $10 million? No, I wouldn't. But with $25,000, I would trade it that way, especially if I'm trying to win a contest. So again, the same thing with your exposure, and you have to define, what is what is acceptable risk for your portfolio. Some people are managing, we have customers that are MPA members that are managing hedge funds. And then we have other people that are managing $20,000 personal accounts. And it might be all the money in the world to them. So they're going to treat it differently than someone else. So again, it really is, and I could tell you how I do it, and that's what you want to know. And you want to know how Mark Ritchie does it. Generally speaking, and again, it changes, it depends. I mean, it might depend how I feel that day. It literally, is that abstract sometimes, but I'm usually, my first toe in the water is 25%, whether it's 125% position or 5% positions. It depends. If a lot of stocks are setting up, I might take a few positions. If there's not many stocks, but I see just a few really nice setups, I might take just one or two. And then from there, if they're working, I'll try to move up to 50%. Now, what if a whole bunch of stocks set up and everything really starts working really fast? Well, I might move even quicker. I might move to 75%. Or even 100% invested. So it depends on, how quickly the stocks are working and how quickly there's more setups and the setups are holding up. Average gain and average loss. Okay. Again, if you ask the question, people want to know, oh, what's Mark Ritchie's average gain and average loss? He's up 300% this year. What's Mark Minervini's? What are they doing? Well, the real question is, what is yours? Okay. And that's what's more important. I know you want a goal to shoot for and you want to emulate, but the bottom line is that, again, if you're trading shorter term, that number is going to be completely different than someone who's trading longer term. And it's going to be all a function of your own risk tolerance and your own style and your own tolerance for being able to hold through pullbacks and so forth. So again, but the bottom line is that, you're going to have somewhere in the neighborhood of 3 to 6% losses trading a swing strategy. So right there, that tells you that you're going to have at least 2 times that on the gain side. So that's what you want to shoot for. You want to shoot for 2 times risk minimum. And if you're not there, well, that just means that, you're not effectively executing the strategy, because that is a minimum number to get to, say, 8 or 10 or 12% average gain. That's really a minimum number. And you can make tons of money with that number. But again, it has to be in relation to the risk. So I'm just going through some of these questions that I heard, and I wanted to just give you my take and clarify a little bit. Secular bull market versus a cyclical bull market. All right. A secular bull market is a multi-year bull market with corrections within that big long-term trend where you have fundamentals are very strong like we have now. This is a secular bull market that's lasted since since 09. And we've had cyclical corrections along the way. Now, a secular bear market would be you're in a downtrend and you have a long-term recession and a long-term situation that is negative for the market. So just cyclical is shorter in nature. These have been cyclical downturns within a secular bull market that we've experienced since 09. Let me see if there's anything else. Okay, I answered that. Let's get to some more questions too.
If you're trading a bigger account, how do you play stocks under 500,000 shares average daily volume, or do you not play them at all?
Well, you'd have to have a pretty big account to not be able to go with 500,000 share traders. I mean, I've traded $50 million and bought stocks that were traded 50,000 shares a day. So, but did I take a huge position in them? No. It has nothing to do with how much you're trading. It has to do with how big of a position you're taking versus what the volume trades. So the rule of thumb is, 10% of the volume. So if it trades 500,000, 50,000, but I probably wouldn't even do that myself. But again, I wouldn't look at it that way. I would just say, whatever the stock is, if you go in what you feel you can safely get out. That's pretty much it. I mean, if you feel like you can't, sell 20,000 shares very easily in a name, well, then you shouldn't be buying that amount. You should be buying less. But I just position size accordingly. I'd rather be, if I just have 1,000 shares in a stock, that's some small name and it doubles. I'm happier than, having a big position in a bigger stock that goes nowhere.
Stephen was just asking, he bought BSY here on December 31st, if this was a good buy.
Well, it's an excellent buy, and I'm not saying because the stock went up. It's just a perfect cup of handle. You had a cheat area there a little earlier too that you could have maybe bought some through, but yeah, it looks fine and it's fantastic. The question is, did you sell it? Do you still own it?
They sold half on the gap up here on January 8th and moved to stop the break even. How would you play the remainder of the position in this type of market?
I'd probably already be out of it, but that's just the way I'm in and out. It's really, again, this is a total personal decision. All right. The bottom line is are you trying to play it for a much bigger move? Well, then you might give it some room. Do you want to free roll it? Are you okay with giving back a big portion of that gain? I don't know what kind of dollar amount that is, if it's life changing to you. I mean, if you put, a good amount of money into a stock like this and you're up an amount of money that it's a major, major amount of money in your life, I wouldn't risk it. There's this, I have a saying in trading, never bet your lifestyle, and also, nail down profits that are life changing. So I just, again, these are personal decisions, and it would really depend on the size. I mean, if took a huge position in it and I got this big dollar gain, yeah, that's going to affect my people, might say, well, that shouldn't affect your decision. You're going to play risk reward, just like, you'd play poker and treat the odds. No, it doesn't work that way. We're human beings with emotions and a $20,000 profit might be an enormous amount of money to one person, and to another person. I've seen people, I've known people who took $50,000, turned it into 10 million, and had to go all the way back down and lose the 50,000 and the 10 million and go to zero in options. I've watched that happen several times, and people I know, and they laugh about it. Me, I'd probably commit suicide if I ever gave back $10 million. I could never live with even a remote drawdown from those highs. But I've seen people do that and laugh about it because they felt like, it's no big deal. It wasn't my money in the first place. I don't look at it that way. Once that stock moves up, it is my money. It's my money. If all you got to do is hit the sell button, and it's your money. At that point, it's your money. But if you let it go down, it won't be your money anymore.
Yeah, you were up 30+% up here. You've been close to 40 at this point. Using Mark's methodology, he would definitely be peeling off if you haven't been a long member here. BP is asking, in this environment, do you find or recommend applying more weight to buying a breakout later in the day versus the open, where it seems a lot more novice money and reversals are happening? Any sense if this might improve the batting average a bit?
Well, it might, and it might not. I mean, you're only going to know in hindsight. But that's having an opinion now. Okay. And now you're going to miss stocks that do break out, and the breakouts are good early in the morning. I'm going to let the stock dictate that. If the stock breaks out, then I'm going to buy the stock. I'm not going to get into having those preconceived notions. That's a very slippery slope. Again, if you want to ignore the first 15 minutes or half hour, some people do that. David Ryan tends to ignore the first half hour of trading. Some people call it amateur hour. I've had a lot of great stocks that I bought in that first half hour. If you see, most of the time I'm buying in the first hour. But that's just because if the stocks move, or they're set up, then I'm going to let the stocks dictate that. But again, you can try that if they hold up, and some name doesn't break out, and then later on it breaks out. Yeah, I would certainly trade that. But when I hold out and not buy, there's 10 names break out and I say, no, I'm not buying any of them because I'm going to wait till the end of the day. No, I personally would not do that.
Question on Airbnb here: is this a cheat area entry on a primary base?
It's a little sloppy, but it is a cheat area. Yep. And it's worked. But it's a hair sloppy. It probably, if it was a little tighter, that's one that I might have been in.
Joe's asking, on a daily chart, you always use log scale? Or the question is, do you always use log scale? Sometimes a chart will look distorted like NVAX, and log scale, it looks tighter than it really
You don't have
is.
to, well, you don't have to use log scale. Log scale is for when you want to compare and make sure that, a percentage move of say 20% down in the lower part of the chart is the same in the upper part. So you get you can see, reference points. If it's a big move, you want to have log scale. If it's not a big move, then you can go with arithmetic.
We often talk about taking note of our average gain and loss at a stock level, but would it make sense to track our average gain at a portfolio level? Francisco is asking, could it be useful information to anticipate imminent drawdowns and maybe sell almost all positions when we achieve short-term portfolio gains that seem very high and prone to a partially revert back?
Oh yeah, absolutely. I mean, and you'll know your own tendencies and what when you're stretching it. And Mark, I'm sure at some point when you see you have a whole bunch of stocks that have a certain percentage gain, you're probably saying to yourself, okay, we're stretching the rubber band here, right?
Right, right. I would say, yeah, absolutely. But I wouldn't time it though, in terms of saying, well, I'm going to revert. So I wouldn't, I
Right.
would absolutely, if things are extended and I'm at multiples, yeah, I'm going to be peeling things in, but I would not say I'm on a good run. I would not then not take new setups.
Right.
I think there's sort of there's a slippery slope there of saying, well, I've been doing really well. Maybe I should just dial back. If things are working well, I want to keep jamming it until it's not. You know what
Right.
I mean?
Yeah, it can go for a long
It can
time.
go for longer than I that I would have otherwise anticipated.
The other thing too about whether you should, kick the stocks out, what you can do is you tighten up the stops. Like for instance, if a stock goes parabolic, that's when you really want to like cinch up the stop, because when they run up like that and they accelerate, the downside is very sharp. And sometimes it happens so quickly and so deep that you give back everything that you would have gotten, even if you sold it sometimes much lower into strength. So again, just you can start backstopping it. If you start getting where you have a whole bunch of names, you backstop the extended names, and then you add in the new names that aren't extended.
Ken's asking on CALX here, is this a good setup that broke out today?
I don't think so. It's a very, very short. Again, see how short that is. I mean, that's not a cup with handle. I mean, it is a cup with handle as far as what it's mapping out and tracing out its shape, but you're looking at 1, 2, 3, 4 weeks. 4 week bases generally need to be power plays, or maybe a base on base where you're sitting on top of a base, where you've come out of a large base and then you've moved sideways for 4 or 5 weeks. Maybe the market was weak during that period and it might come out of a natural reaction. Now that this may work, this may work in a good market. This may work, but I can tell you right now, again, I just look at it as what kind of hand is this being dealt to me? I want aces, I want kings, I want queens. I will play jacks and a pair of tens also, and I might even play even a smaller pair, or I that at times. But I know that if I keep playing and I keep playing a pair of twos, over time that's a losing hand. That's a losing hand. All right, this over time is probably a losing hand. Uh,
Definitely.
yeah, it's because it's
You
extended, it's short, it's
you play that 1,000 times, you're gonna lose money.
yeah, you're going to lose money. And here's my general rule. This is what I've found. I have found, and I from time to time I tell Mark Ritchie this. Sometimes we're tempted to buy some of these shorter bases. What I take a look and see is has the stock gotten extended and then made a short base. I have definitely lost more money than I've made money in those situations. When a stock gets extended and then it makes a short base, those are situations that I have cost me money.
This stock was put on buy alert at the proper, or a breakout alert on the proper pivot on that low cheat back in early December.
It was.
Yep.
I don't remember.
Yep.
Yeah. So see again, that's you have to get good at buying it at the lowest risk entry, coming from good size bases. And another thing that you really want to start to look at, and I always look at weeklies. You bring this up on a weekly. Does it look good on a weekly? And again, it looked coming out of that right there. It actually looks very nice on a weekly as far as the action is concerned. The recent action looks really good on a weekly. So coming out of this, for a trade, maybe you can trade this, and if it runs up, you just you sell into the strength. But the weekly looks very good. But again, it's only 1, 2, 3, 4 weeks. It came out of a 4 week base. So some people call it a Darvis box. They could be traded when things are working. You get bailed out of a lot of sloppy trading and a lot of mistakes and a lot of things that you would get crucified for in different type of market. But again, is that going to work in the long term? That's the real question.
All right. Janine is asking, looking at 2 recent trades, PayPal and Shopify. PayPal at 5.3% risk, and the first sell at 9.5% profit. Shopify had 5.6% risk, the first sell at 17% profit. How does Mark decide to set these 2 different profit targets for these 2 different trades? I'm having trouble with this.
I'm not setting a profit target. I'm just selling the stock based on whether I think that it's extended short term and whether I want to pad my risk. It's pretty much that simple. If this was coming out of a bear market and you're coming out of a nice size base, I'm still going to sell these stocks for this service. I'm going to sell these stocks. I'm going to roll it over because we have to constantly have ideas. So I'm not going to take long-term positions and show PayPal that we bought it 2 years ago, and anybody that's on the service within that time can't participate. It just doesn't make sense. So we're not. That's what we try to do, though, is show you how to do that. Okay, if you were buying at that point and you're coming out of a bear market, it's not a stock you'd probably want to start selling out, just up 10 or 15 or 20%. But again, the question is, what's the difference between the 17% sell and the 9 or 10% sell? Well, again, it's a lot of things can come in play. I mean, I might just be doing poorly at that point and just got clipped on a bunch of names, and I want to nail some profits down and offset those losses. See, I'm always thinking risk. I'm always thinking of keeping my buoyancy, keeping myself where I'm not losing money. I don't care about making money. That's going to happen as long as I don't go underwater. If I go underwater, then making money isn't even going to accomplish anything. It's just going to get me back to even. So you can't lose big. That's the key. So if I'm making mistakes and I'm breaking even, that's fine. That's fine. So I'm good to fight another day. So let's say maybe, things are, we had a period here where just how many stocks were coming out and then reversing and stopping out and having big squats. So, again, I don't know what I'm thinking at that particular time, but a lot of times that's a reason that I'm saying, okay, well, I'm not falling for that trick anymore. I'm getting out of here and nailing down some of these profits, at least on part of the position. See, if you sell half, you're in a win-win situation. You put yourself, when you get at a gain, as soon as you get at a decent gain, that's a multiple of your risk. You've achieved your goal. Like, okay, here's a very good point. And I think this is this is probably one of the main keys to my success. My idea of trading stocks is that I want to try to play for larger moves and get as much as I can out of a stock before it pulls back, excessively, before it gets too extended. However, I look at it this way: on those shorter term plays, let's just say that in all those half positions that I sell out up 8, 9, 10, 12%, whatever they are, would I make money if I just did that? The answer is absolutely. Absolutely. I'd make a ton of money if I just did that. So now, if it doesn't mean I want to shoot for, a bigger return, but does that alone work? Does that stand on its own 2 feet? See, every move that you make needs to stand on its own 2 feet. So you have to say to yourself, are my longer term plays, if I just did the longer term plays, would they make money? The answer should be yes. If I just did my short term plays, would they make me money? Yes. Okay, now we can blend them. And by blending them, why are we blending them? Well, because we might, one way might work a little bit better sometimes than another. And also we're trying to cushion the equity, the drawdown. So when the stock moves up, yes, okay, it pulls back and you're a genius because you held through a 40% pullback and then the stock doubled from there. No, you're not a genius. You're lucky. You're lucky that it didn't just keep going down. You had a big drawdown. See, I don't want that drawdown. I want to sell into the strength. If it pulls back at resets, I might add it back. But my goal is to not have drawdowns and to constantly chip up. It's just like if you're playing in a poker tournament. They use the term chip up, chip up. You're just trying, in the early stages of the tournament, you're just trying to chip up, chip up. At the end of the tournament, when the blinds go up, you're forced to make reckless bets and to do things that you normally wouldn't do because you're going to get eaten by the blinds. Guess what? Here's the beauty about the stock market. There's no ante. There's no blinds. You sit and wait for free. How could you lose? If I were to tell you you're going to play poker, all right, and there's no ante, there's no blinds, you could sit there and wait forever to get aces. How could you lose? Okay. You couldn't unless you were impatient, undisciplined, greedy. Okay. And even you say people go, well, people just fold when you play your hand. No, they wouldn't, because they're not disciplined and they want action too. Okay. No, they wouldn't. There's always some sucker at the table that wants action, especially wants to beat the guy who plays tight. So it's the same thing with the market. If how could you lose if you're patient and wait for aces?
And in the stock market, by the way, you're not playing at one table with the same 10 players every day in and day out. You're always going to get action. It's a calling station.
That's right. There's always the texture of the game is always changing. There's always action, and it's the biggest game in the world. This is the biggest poker game on earth. With 99% of the players suck. Okay, 99% of the players that are on the other side of your trade are terrible. They're terrible. If you're not taking money from them, well, then you're not doing your homework. All right, let's go on.
The one thing, Janine, before I sensed the rant was coming, the one thing I'll also share with you is Mark doesn't set price targets because he's just able to watch the price action. And if you see the Shopify here, it had a big extended move. Then it came right back in the next day. It gapped up the next day. And this is where Mark said, all right, taking that first half off at 17%, but there was no reason. It wasn't doing anything that would give him a reason to really sell before that point. And so that's the difference. If you say I'm always going to sell at 10%, you're going to lose out.
Bob, let me ask you this, or let me ask this question. So people are getting 0.5% on their money in the bank for a year. You just made a trade. You made 20% in 4 days. You're not happy with that? You don't think you can get rich by taking 20% in 4 days? To do the math, how many times do you have to make a 20% return to double your account? Even if there were 25% positions. All right, just do the math. All right, if that's all you did was take 17% profits in 4 or 5 days or 4 or 5 weeks, you should be able to double your account, triple your account. That's why Mark Ritchie's up 300%. All right, we did a kind of a little experiment. I short-term traded an account throughout this year. I'm going to talk about those results, and we'll talk about Mark Ritchie's results, because we did 2 completely different things and both came up with a great result this year. And I'm going to do that in another session. I'm going to share that. But there's a lot of ways to skin the cat. But the bottom line is that if you have to, people get stuck into this mindset of they want to get this big giant winner. Okay, look, my goal is to make money, compound the money, and make the return. I do the math. I say, okay, if how many stocks go up 10% in a few days to a few weeks? All of them. Every single stock goes up 10%. All right. So that's great. That gives me this giant universe of opportunity. So how many of those 10% winners do I have to have and compound against, let's say, 5% losers? So net 5% per trade. How many of those do I have to do in a year to get me to 100%? You do that math, it's a pretty nice answer. It's a very doable answer. So that's what I was saying. If you just took 10% profits and 5% losses, you were right 50% of the time. Guess what? You should be a triple digit trader.
And that's what the RBAF calculator tells you guys in the analytics tab, by the way.
Right. And if that alone, now, of course, you want to try to extend that and do even better than that. But that alone will get you there. So ask yourself, whenever you're making a sell decision, all right, so I'm selling Spotify. I'm sorry, which was the one that I sold? Shopify up 17%. And I risked whatever it was, 5%, 7%. Okay, so I ask myself, if I just did this, if these are all the trades I did, 70% winners and 7% losers, would it be a money-making situation? Would I make money? Absolutely. Well, that's not a bad sale.
I think she's asking why you were able to hold on to get to 17% versus PayPal here. You only were able to get 9.5%.
Because that's all it went up.
So this is where I was saying, Janine, the price action here, we bought PayPal on this day to gap. It went up It stalled for a day, it stalled for another day, and now that price action Mark's analyzing is not showing the strength that it is giving him high
Maybe,
confidence.
but that's not, but that may be the answer at the time, but that's not necessarily the answer, and not necessarily the answer all the time. I
Yeah,
might just sell just simply because I'm happy with that profit at that time.
yeah,
I'm like I said, I'm not getting as big profits. Things aren't working as well. So okay, I'm doing the math. I risked 5%. I'm up 10%. All right, I'll take half off. Even if I just did that, it's a moneymaker. It's a
yeah.
moneymaker. You see, I'm not into this ego thing. I'm where I have to, I'm worried that I'm going to sell the stock and then PayPal's going to go up 40% here and I'm going to kick myself and say I should have held it. See, that doesn't have any role in my trading. I don't care if this stock goes up a tenfold from here. It doesn't matter to me. It's not that my goal isn't to find the big winners and stroke my ego. My goal is to make the return and to compound the return and get that return however I have to get it, whether I have to day trade myself to it or and scalp or take 10% profits or hold for bigger moves in the beginning of a bull market and have much bigger moves. It all depends. It all depends on, you know, what's working, where you are in the cycle, what your style is, but it all comes down to the math. It all comes down to that math. And so I'm not making decisions. I can tell you right now, I'm not taking I'm not taking a 5% profit. Did you notice that? I don't sell stocks when they're up 5%. Now, you may say, well, sometimes you do. Yes, but that's because something's wrong. That's because either something's going wrong with the stock or I see the market, the things are changing and we're getting hit with a bunch of stops. I'm trying to reduce my exposure, but just on the analyzing the stock, should I sell this stock here? I'm not going to sell it at 5% if I'm taking a 5% risk. It doesn't make any sense. If I now see, ask yourself, if I did just these trades, if I took 5% gains versus 5% losses, would it be a moneymaker? No. The answer is no, it would not be. So that's not a good place to sell. and if you can't get a multiple of your risk, well, then you're not placing very good trades. You have another problem to address. You're not buying the proper setups. But if you buy the proper setups, believe me, 10%, 15% gains are your minimum level that you should get on the upside pretty easily. Otherwise, the market's not good. It's not a time where you should be trading in the market, and you wait for that time to come.
Quicker question is Mike asking to clarify the 2-to-1 trading ratio. Are you using that based on the net result of the trade of your stop average loss, or are you doing it from the initial stop? For example, you sometimes set it at 7, you then tighten the stop, and if your average loss is less than the original stop of 7, would your 2-to-1 be based on that net average loss versus the initial stop that you're using?
It would generally be on my initial stop. Now, of course, the trade is dynamic and it changes, but you did take that initial risk. So you have to realize that that may have not gone your way and you would have been hit with a 7% stop. So that is going to be your numbers on the downside. The ones that don't work out are going to and hit that initial stop. So you can't say, well, the stock's going up and now I set a 1% stop. So if it goes up 2%, I'm going to sell versus 1%. No, it doesn't work that way. Anyway, Mark Ritchie, you must be loving this because he loves when
I am. This is great.
I know. I said he must be sitting there smiling.
Dean is asking, he finds a lot of trades taken off right away. Is it a safe practice to use buy stop limit orders just before the market opens to avoid some stocks running away from you?
Okay, well, that is one of the things that I'm glad you threw me that softball because I was hoping someone would give me the chance to tell you that we're not going to put the buy alert list after before the open anymore. I tried it this week or last few weeks, and I know by watching the trading that many of our clients are running in there ahead of time with buy stops, and this is why I don't put it ahead of time. So everybody can put buy stops in, let the market makers hose you on the open, and then I miss all my trades like I did this morning. All right. So again, I'd rather have you be surprised on some of these names and miss some because I'm trading them too. All right, and I'm not going to let. We're not going to let a few people, a handful of people that that want to buy before the stocks break out or going in there and being irresponsible to ruin it for all of us. So, but the bottom line is that I would not put orders pre-market. I think it's a very bad idea to put a pre-market order, let the stock open, see where it is. Now, if that's all you can do and you work a job, you don't have any choice. Obviously, that's the only way you can do it. Some people, they can't do it that way, so you'd have to do that. But you're really asking for trouble, and you're asking for trouble to give us all trouble, because you will get taken advantage of if you put some order in there that's above the market, pre-market. Yes, they'll gap the stock on you, especially if it's a thin name. You're giving the market makers, the specialists, the opportunity to take advantage of you, and they will. So, they talk about manipulation. The market's not manipulated. All right. It's not manipulated. You may say that's manipulation. No, that's not manipulation. That's supply and demand. You're showing your hand. You're saying, I want stock at this price. Well, they control the demand side to a certain degree. In a very small sphere, they only have to honor 100 shares at any one price. That's the order handling rule change that happened in 1997, where they screwed everybody and changed the rules. It used to be that there'd be 4,000 shares at every price or more. Now, market makers only have to honor 100 shares at each price level. So they can take the stock up on, if you have a 5,000 share order and it's 10 cents away, they can take it up on 100 shares. So they blow it on 1,000 shares, but they pick up your 5,000 shares. Now, again, this is getting into something that's probably very complex for some of you to understand, but this is market making, and these are the dynamics that happen within that small, in between the bid and the ask. There's room there. There's room there for them to move around, because there's no real supply anymore. There's no real size. There used to be size on both sides, the bid and the offer. There's no size anymore. They have some. The real size is invisible. All right. So maybe the real size is 50 cents higher and the spread is 50 cents, but you're seeing a penny spread and you're seeing 100 shares on each side. That's not the real spread. The real spread might be $1 before you actually hit size, and they can take you to that point. And that's why.
Follow-up question on ARVN was asked with the buy point. Just trying to understand why the buy point was the prices that were set, that being 84.60, and just showing you here the prior day's high was 84.48. So Mark was just waiting for it to take out that prior day's high, and on the low, on the stop, which was set at 79.85, you'll see that's just below the prior day's low.
So
So
ARVN, this came out, let's see, 1/7. Hold on one second. Let me just pull up my records here. I got to move something around here. All right. Yeah. So ARVN, we were stopped out of that originally. Is that correct? I have an 86.55 buy on 1/7.
Correct.
Right. Then it formed sort of a little mini failure reset. So let's just go through this trade and talk about what happened here. So I decided on this one that I was going to play this from that very short. It's so strong. I mean, it just look at this move, and it barely would pull back at all. So in my mind, this stock wants to go higher. It's just a matter of me timing it. So some of these have been working because we have a lot of these. Like I said, there's a lot of amateur traders. It's retail hour now in the market. They're running some of these names up out of these 5-day pivots, power plays. This meets the definition of a power play. However, it was very short. Sometimes we call these a short stroke play. So I tried it. I tried to see, maybe it's just going to go here and it's going to just pause for 6 days or so and go. Well, it didn't, and it pulled back. And then it set up that little, we really looking microscopically. It's sort of like a little low cheat within there. So from there, I still believe in the name, because it has pulled back so little with such a giant move. This stock went from $20 to $80, so over $80, and barely pulled back. What? 10% or so, I don't know, 15%, very, very small pullback. So it's so strong and it's saying, I want to go higher. So then I'm just looking to start buying it as it turns back up, because now I don't want my risk to be too great. I don't want it. Now the volatility, you see, it took out the low and now it moves back up. It goes and takes out the high. Now you're getting, what my friend John Schmidt termed the megaphone effect, where it's actually widening. And of course, Bob's going to draw so many lines that you won't even be able to know what the hell I'm talking about. But and, anyway, yeah, the megaphone effect, I don't want to play into that volatility. I want to start trading now near the danger point. And the danger point is that low. Once it shakes out the low and that one day, that becomes key, because that's where, whenever you get a shakeout, and you guys are learning a lot of little nuances here today. I'm giving you a lot of insights here. Whenever you get a shakeout, any type of shakeout, whether it's a shakeout in a big base, a small base, within a handle, you want to see if it's truly a shakeout. You're going to see the stock come back fairly quickly, usually within a couple bars. Whether it's you're looking at daily bars, weekly bars, it doesn't really matter. And you see, you might go inside. You went inside for a few days, and then it started turning up. So from there, that's actually buyable right there. That's actually buyable, because now you're so close to that low that becomes your stop. And now you're getting a nice low risk entry point. Now, maybe the stock still needs to move sideways and it needs to tighten up. It runs up a little bit, but it doesn't break out. Well, that's fine, because again, if that's the shakeout, you're just going to tighten up. Volume's going to die down, and you're not going to hit your stop, and you'll wait, and then it'll break out. It'll probably improve, and you'll be able to add to the position. So that's the thinking on that one. It was definitely creative, as Mark Ritchie would say. It was, but I think it was just trying to get in early and playing this theme of a lot of these stocks breaking out of quote unquote power plays, prematurely. I don't even know if that answered the question, but that's my answer.
No, it did, because I went through the prices, why those prices were the prices you set. A question from a new member, Mehdi, had asked about NOA being on buy alert last week, and it broke out. Curious why you just didn't buy it.
Yeah, low price name. It was a little sloppy on the right side, so it was good enough to show you guys. Like I pointed out in this week's video, some of the names are buy alert that came out, and I didn't trade, and they blasted off to the moon. This could have been another one, But see, now it tightened up a bit. If this tightens up a bit, it might improve, and it might end up making it. But again, let's rank the hand. Okay, let's rank the hand. We don't have real tightness on the right side there just yet, right? So it's not perfect. It's a $10 stock. Okay, that's a demerit. It's not tight on the right side. That's a demerit. The relative strength is 84. That's a demerit. The uptrend, it's an early turn. It's just starting to turn into an uptrend. It's not in a confirmed uptrend. That's a demerit. Okay, you see, look
earnings aren't that good either.
The earnings are crappy. That's a demerit. I mean, we can keep going. It's in the oil field services area, which has been crappy, is just starting to do well. I got DKL. I think that's a perfect base it came out of. And again, that was an early turn also. But so, I have to, and actually looking here, show you another little, a lot of people don't know this, but if you see where Bob underlined oil and gas field services, and you see 8/197, that's a great little indicator right there. Well, I shouldn't say indicator, but that tells you that it's ranked, the group is ranked 8 out of 197 IBD group rankings. So you can immediately look at that. A lot of people don't know this. You look at that and see where the group ranks. Now I can assure you, and then if you click on that, it'll bring up the group. I don't know if I want to screw you up too much, but if you click on that right there, yeah, you see, it brings up a chart of the group. All right. It'll bring up the group, the top stocks in the group, and you could start looking at an analysis of the group. That's an actual chart of the group. And then you can go and look at individual stocks within that group and so forth. It's really very, very cool the way they make it, where you can, one click and move yourself around. So I would be willing to bet that if you went and looked at the IBD rankings, and there's another, you probably don't know how to get in there, Bob, but there's a way you can look and see where it was. Oh, actually, it's right down at the bottom. If you can look back 6 months and 3 months, I'll bet you if you look at the oil services, which are number 8, go down to number 8. Go down to number 8.
Right here.
Okay. I would be willing to bet that they were in the bottom 100, and now they're, see, 188, 100, and now 8. So that's what I call it a group improvement data screen. I actually look at this and see, have we gone in the last 3 months, particularly in the last 3 months, but I also look at the 6 months. Have we gone from the bottom 100 to the top 40? And that means that you've got an acceleration in the group. Now, the problem is a lot of the best stocks already move before you even see this, but sometimes they don't. Sometimes you see this and you can see a group that's moving. So I look for that. Now, I didn't even have to look at that. I just know by where oil was and where it is now, I know that there's probably been a big group improvement on that, and I'm correct. Anyway, let's go to another question.
I think we're getting close to wrapping up here. It's been over an hour and 20 minutes.
Yeah.
Let me just see if there's one last question. John is asking if an important part of our strategy is institutional buying, how are we sometimes buying micro caps? I understand the pattern is there, but they're too small for institutions to buy, so it will only be us and other retail buyers.
Oh, really? Institutions don't buy microcaps? Really? I didn't know that rule, but you're wrong. Our institutions buy. How do you think an Amazon becomes an Amazon? So that's incorrect. All right. So microcap, what do you want to do? You want to buy a stock after it's made a big move and it's Amazon after an 80,000% move, or you want to buy it before that? So the biggest move, the biggest money is made. You wouldn't know it in the last, whatever, how much time the mega caps, this has been a theme. The mega caps have done really well. But I can tell you right now, looking at history and going back to where almost all my wealth has been made, most of the, Bill O'Neill's, most of the guys that I know that use growth strategies, looking back at the biggest winning stocks, the data is clear. Small and mid cap names are where you get the biggest winners. So, and it just makes sense. I mean, it's supply and demand. Would you rather have, well, let me just put it this way. You don't need a lot of institutions to move a stock. See, you would rather—
That's a golden nugget right there.
Yes, this is the golden nugget. Absolutely. Let's just say that you have a company that's got 5 million shares in the float. Do you realize that just one mutual fund can double that stock? And they'll double that stock and keep buying it because they're playing it for a 10 bagger. And to you, it's this giant, it changes your world. But to them, they're just taking a position. And God forbid, 10 institutions want that. And that's what happens. That's what happens. You get this feeding frenzy, and that's how you get these giant moves and these names. And you're not going to see those giant moves too often. Yeah, there's the Tesla and there's occasional, you get these mega caps that make these big moves, but you're talking about so few and far between. The smaller names are where you want to be, and the institutions do buy the smaller names.
So I think on that note is where we'll wrap up for the week. And I know we got through a handful of questions, but not all of them. So I do ask you just to remember to keep those questions written down. And, these are timeless questions you guys are asking, so we can always go back and review. Also, as a reminder, the symbol Dropbox on the platform is where you do have the ability to send directly to Mark's computer, these ticker symbols that we did pull up a few of which, but that is really the mechanism to send any ideas you have to Mark. If he likes it, of course, and it meets his criteria, he'll have it added to buy alert, and that's how you'll start seeing names that that you're finding that are meeting
Right,
market
but
criteria.
I have to interrupt you for 1 second, because it doesn't mean there's days where I don't have the time to look at the list, and there might be a delay. So don't think that because your stock didn't make it to buy alert that I don't like it. But most likely I'm going to see most of the names that you bring up. But every now and then, I have to say, every now and then, definitely you come up with a name that I didn't see for some reason, and it looks good. And you might see it come up there. But yes, if you want to show me what you're looking at, I don't get to see who the person is. It's anonymous. But I do look at it from time to time, and particularly on the weekend. And but again, it's not a guarantee that in any one day I'm looking at the list.
Yep.
I got to run. I'll see you guys later.
All right, Mark.
Yep.
And well, you will have the ability to watch this replay here momentarily afterwards, but otherwise we'll pick it back up on Monday next week and watch and monitor the platform for any updates from Mark for the remainder of the week. And thank you, Mark Ritchie, for your time as well.
Take care, guys.
All right. Enjoy the football games.